It's James Walker-Powell from More for Life Financial Services. And again, we've got Anthony Doyle, the High Priest of Pinnacle's fund management business, here today to talk to us about what's happening in the economy and what we can actually expect. But before we go any further, Anthony, would you like to tell us a bit more about Pinnacle?
Yeah, sure. So Pinnacle, we're an ASX listed company. Mm-hmm. We're around the 110th largest company on the ASX. And we 110th, yeah. We have a market capitalisation of around $5 billion. Mm-hmm. And our business model is very, very simple. We essentially take minority stakes in high-performing investment management boutiques that we call affiliates. We're always the minority shareholder in these businesses. We provide them, the investment teams, with the working capital that they require to start their own investment management businesses. And what that does is create a very strong level of alignment with the investment teams that are managing money on behalf of your clients and the returns that the end investor gets. And so around the world, we now have 19 affiliated managers within the Pinnacle stable. 19. That's growing.
Yeah. What are your main ones?
The main ones that your clients would be familiar with, I know that you use Metrics, for example, for private credit. Yeah. Australia's largest non-bank lender, over 500 staff in that business. Amazing. So when you think boutique, not really a boutique anymore. Hyperion, Brisbane-based quality growth manager in Australian and global equities. Plato, who I know, Don Hampson. Plato was one of our first investment management boutiques, for example. So
yeah, we interviewed Don last year, actually.
Yes. Don, Firetrail, Solaris, all these names would really resonate with most investors. And essentially what we do is we do all the ancillary services that these firms, as investors, you don't necessarily want to do, like legal, HR, compliance, IT, distribution. And that just allows these teams to focus 100% day in, day out on generating the returns that clients are looking for.
What do you do, Anthony, for businesses?
What do I do in the business?
Yeah.
So I joined around 18 months ago now, and I actually worked at one of the boutiques, one of the affiliates called Firetrail, and I was there for 3 years. But I have a background. I'm an economist by training. You like to call them high priests, so spreading the gospel. But I worked overseas for 12 years in bond markets. I've worked in constructing multi-asset portfolios, and actually at Firetrail, I focused on global equities. And so at Pinnacle, I work with all 19 affiliates to essentially decipher the views and communicate them to our clients on a daily basis. And inevitably what you find is that fixed income teams are all doom and gloom. Equity teams are all sunlit uplands, and normally the truth is somewhere in between. And so I like to share that with clients and with financial advisors who are building diversified portfolios for clients from a vast range of asset classes. And so I assist financial advisors on a daily basis on building better portfolios, essentially.
Well, let's get into it. I think one of the questions that many people have is that when they look at the share markets around the world, you've got the Japanese share market, 60-70%. You've got the Australian share market sub 5%, and the US around about 20%. What's happening there?
Yeah, I mean, I've done a lot of work on this, particularly the price experience that we've seen in equity markets over the last 3 years or so. And it really reflects an environment of heightened uncertainty, whether that's geopolitical risk and some of the things that the US administration are doing. And we've obviously had, Russia's invasion of Ukraine. We've had the Middle East crisis as well in terms of the relationship with energy prices. We have higher inflation than we experienced between 2010 and 2020. So inflation in Australia has been above the RBA's target for 4 years. We have fiscal policy, so government spending very strong around the world, including Australia.
So why is the Australia share market so bad compared to, say, the US share market?
Well, the types of industries that make up the index in particular are very, very different.
All right.
So in the US and Asia and China, for example, tech firms make up around 30% of the index.
30%?
Correct. So I'm talking about companies like Amazon and Alphabet, and these companies typically generate earnings growth of over 20% annually.
Right.
Versus Australia, well, the top 10 stocks in the ASX 200 are around 50% of the index.
Yeah.
And when you think about those top 10 stocks, we have the four major banks,
Yeah.
CBA, NAB, Westpac, ANZ, Macquarie,
Yeah.
BHP, CSL, Wesfarmers, Goodman Group, Telstra. And so those sectors, financials, resources, for example, don't generate the same sort of levels of earnings growth that, say, the tech sector would.
Right.
So the Aussie market generally is viewed as a market that is a very strong market for income. Whereas if you're looking for higher growth, then you look international for those higher growth levels. And that's exactly what's played out in recent years, particularly given when you think about the big four banks, for example, they're very domestically focused. They don't have large international, they're not large international banks. Mm-hmm. They're very much focused, and most of that exposure is towards the Australian housing market.
Well, is that healthy at the present stage?
Well, we are in an interest rate hiking cycle at the moment.
Still, yeah.
Inflation is uncomfortable. So it's great news for retirees that are looking to generate higher income from defensive assets, whether that's a term deposit or whether that's in public credit or private credit, for example. I mean, if I spoke to you 10 years ago, when interest rates were at all-time lows, a lot of advisors and a lot of investors would have bitten your hands off for the sorts of term deposit rates that they can get today, sort of almost approaching those 5% levels, for example.
Yeah.
But for the equity market, key interest rate sensitive companies and sectors like, say, JB Hi-Fi or Harvey Norman, in a world where there are cost of living pressures and interest rates are rising, well, by definition, there's less money flowing around the economy.
So what's the official inflation rate? Because I've got a bit of a bee in my bonnet about that one.
So official is around 3.5%.
All right. So
over the last 12 months.
Yesterday, I went up to the local coffee shop man. He was selling a coffee this time last year at $6.30. It's now $6.70. You do your maths, and it's about 6.5%.
Yeah.
I reckon that's actually the real inflation figure rather than the 3.5%. I mean, how can they get away with that?
Well, the CPI, the Consumer Price Index that the Australian Bureau of Statistics produces, essentially that represents the price of goods and services for the whole economy as a whole. Mm-hmm. And around 20% of that index is the costs of building a new home, which is something you don't do particularly often. There's other things that go on in...
20%?
Around 20%. There's other things that go on in the construction of the index. So let's say a car cost $50,000 10 years ago and a car costs $50,000 today. Mm-hmm. Well, the Australian Bureau of Statistics do a measurement called a hedonic adjustment. So they're saying, and this is probably for older cars, but the car you bought 10, 20 years ago had roll-up windows and might not have had air conditioning, et cetera, whereas the one you're getting today has those modern features. So they're saying you're getting more bang for your buck, and that actually represents deflation, but you're still paying higher prices for cars. Mm-hmm. And so what your clients and what advisors really need to do is sit down with their clients and think about where they're actually spending money, because everyone's price experience in the Australian economy is very different. Now, I know you're a great rugby player and have been a great rugby player, but you're no longer buying rugby boots, right, or headgears. Whereas I've got a son, 8 years old, headgear and footy boots and footy socks are still in my inflation basket. So that's what I spend money on. And when you actually look at the price experience since COVID, what you can see for underlying components of the CPI is the price of non-discretionary items. So stuff that we have to spend money on month in, month out.
Yeah.
Insurance is up 50%.
Yeah.
Energy costs, food,
what's energy
utilities, 30%.
Okay. 50, 30, keep going. Tell me
so
more. How about
rates.
Food, what's food?
Rents, food's up around 28%. So essentially...
That's in a year?
Since COVID.
Since COVID, right.
So essentially, Australians, if you think about non-discretionary items of inflation, on average, they've risen by around 30 to 35%, which means that compared to 2020, in $100 in 2020 would only buy around $70 worth of those items today. What has risen to a lesser extent? Discretionary items, games, toys, books, hobbies, AV equipment, stuff you don't necessarily have to buy on a monthly or weekly basis. And so Australians, a majority of Australians, the average Australian is seeing their standards of living eroded because non-discretionary items of inflation are rising at a much faster pace than the overall level of inflation.
I went to a restaurant last night and it was packed. But it was packed with people my age and older. There wasn't one young person there.
Yeah.
What's happening there?
Well, I'm not surprised. So in Australia, we now have very different experience of the economy. Those that have generated wealth from, say, superannuation, or they've had their house paid off, or they're entering into retirement phase, generally that's the cohort of Australians that are of an older demographic, and they are spending like drunken sailors. Whereas those that are really feeling the pain are renters, those that have a mortgage, those that have a young family, those of younger generations that don't have the same sort of level of incomes. They're actually feeling...
Or they're paying this mortgage off.
They're feeling the cost of living squeeze. And so, as I said, where do you start to tighten your family budget? Well, it's on those discretionary items like going out or even having a coffee.
Yeah.
And so with that in mind, when you're thinking about constructing the outlook for GDP, the reason I'm more optimistic than what the headlines would suggest is that, to give you a statistic, in the US, the top 10% of households by wealth account for 50% of US consumption.
Is that right?
In Australia, we're closer to around a third because we're not as, our levels of income inequality aren't as high as the United States. But still,
thank God for that.
Don't forget, it wasn't that long ago that interest rates responded to higher inflation. And so the world was, most economic analysts in Australia were very concerned about the repricing of fixed rate mortgages in COVID to higher variable rates, but we sailed through it. So Australians have a lot of cash in reserve. They've built up offset accounts. They have saving buffers. They'll start to eat into those saving buffers. But in terms of the outlook for economic growth, you don't typically see a recession when consumption holds up, and that's exactly what's happening as the baby boomers are spending.
So the baby boomers are doing the heavy lifting.
Correct, yes, and have done really since COVID.
Right.
So Commonwealth Bank come out with some great statistics around this, which show that discretionary spending from boomers has increased, whereas spending amongst younger demographics is actually going backwards.
Yeah.
But what this means is, from an economic growth perspective, the Australian economy is likely to not enter into sort of any recessionary environment because government spending is so strong, and consumption, it might weaken to some extent, but it will still hold up. And you don't get bear markets in equities unless there's a recessionary environment.
So,
I was just going to finish that sort of train of thought. What that means is that if a majority of Australians are going backwards in terms of their standard of living, we saw this with Brexit, we saw this with Trump's first election and even second election win, we've seen it across Europe. The majority of Australians are saying, well, the economy is not working for me anymore, and the established political framework isn't working for me, so I'm going to protest and I'm going to vote for an outsider. Mm-hmm. And in the UK, that meant leaving the Eurozone project and the single market. In the US, it meant voting for Donald Trump. And in Australia, what that means is that increasing popularity of One Nation in polls, for example.
Do you reckon she'll get up?
No, I don't think so. But what she will do is, and Pauline Hanson, is she will make the established political parties reconsider some of their policies, whether it's around migration, whether it's around housing, whether it's around spending, whether it's around even superannuation. Pauline is very much setting the agenda in terms of the headlines that she's generating, and she will drag probably the coalition further to the right, and maybe the Labor Party will move further to the left, as it suggests with the most latest budgetary changes, for example, in May.
So back to the markets, let's talk about what we can expect in the future with the US markets, I was saying that they've performed well over 20%. You're saying that that's got a lot to do with AI. Can we expect that to continue?
Yeah. My view is I'm optimistic on the outlook. I'm actually pretty bullish for equity markets in general.
Right.
What's really exciting for advisors that are building client portfolios today is we've seen earnings growth broaden out from a narrow sector in tech and growth to now one where cyclical companies and defensive, like resources, for example, and defensive companies are also generating higher earnings
So
growth.
defensive companies like Woolworths, would you say?
Yeah, consumer staples, for example, is a good example. And so that earnings growth is broadening out. But what I will say, and in relation to volatility in the market, we saw Amazon up 20% in 3 days. Last night we saw Moderna, if you remember the vaccines, up 160% in 1 day on a positive drug trial. And so the market
What was that? What was that one?
They've had very good response to those that have had melanomas.
Right.
Not curing melanoma as such, but once the melanoma is removed, administering the drug so the melanoma doesn't come back.
Wow.
And so that is viewed as a significant step in terms of the potential path to finding cures for other types of cancers. So it's not a cure, but it is definitely stopping. Well, the trial would suggest from the headlines I read on Bloomberg this morning.
We're closer to a cure.
Yes, and so the market has reacted to that by bidding up the price of.
Remember the old adage, mate, it's not a cure for cancer.
Yes. Well, I mean, fingers crossed. We'll get there, and AI is helping to facilitate many advances in drug development as well, and better health outcomes. So you can find now that AI is being used in hospitals around the world, but even in terms of diagnosing tumours on X-rays, AI can do a better job than physicians with a lot of experience, for example.
So tell me, other than sort of like the medical area, where is AI making a significant impact in business?
So a lot of it, what we're seeing is coming up at the moment is in the productivity figures for the economy. So I'll give you an anecdote. 18 months ago, we had 0 people in our AI team here at Pinnacle, and now we have 6 individuals that are focused in on AI within Pinnacle, and also our affiliated managers and boutique managers as well.
What do they do?
Well, essentially, they work with the teams around the business in order to determine how we can use the tools of AI to improve the productivity of individuals within the teams. So this could include...
Is that coming to fruition or what?
Yes, absolutely. Yeah. So, I mean, we use AI. Like, for example, we have access to Claude, we have access to Cowork, we have access to ChatGPT.
But everybody else does that, don't
Correct.
they?
Yeah. But I mean, I've used Claude recently. I used to build portfolios, and I used to build, I still do, build correlations between asset classes, et cetera, and look at how they're moving. Wow. And so typically what happens in crisis is that correlations will spike to 1. And this might have taken me 4 hours of analysis to produce between downloading the data, building the Excel formulas, drawing the charts, et cetera. So I did it, and then I tested Claude to see if it could replicate it. And I put into a chat box what I wanted Claude to do, integrated it into Excel. I had all the data there waiting for it. I went and got a coffee, came back, compared the results. They were the exact same. So what used to take me 3 to 4 hours of analysis, Claude can do in 5 minutes. And that enables me to focus somewhere else. And we're seeing those use cases right throughout the business. And it's really only limited by your own creativity.
I might just chime in there because a bit of advertisement for More for Life Financial Services. We've had 2 really good graduates from Sydney University come in and try and AI our office. And we had some success. We had some not so much success, but one of the success stories they did for us is they designed a second opinion calculator. So you can actually drag your portfolio into the second opinion calculator, and it will give you an analysis of your portfolio. So that's in our website.
Yep. And we have members of our team as well developing apps and As I said, it goes down to how creative do you want to be in addressing some of the problems that you face in your own workflow. And so for financial advisors or for clients that are integrating these tools, what that means is that your productivity is improved. And whether you're seeing this for a small business or for a listed business, essentially revenue should inflect higher because your output per hour is getting higher. So that might, for a financial advice business, it might mean you can see more clients. For a coffee shop, essentially, maybe you could implement robotics one day to serve up the flat whites. For industrial companies, what we're seeing is robotics implemented through supply chains. So it's extraordinary.
We pay around about $350 for the cleaners to come, every fortnight. When can I actually buy my robot that's going to clean my house?
Well, Elon Musk would tell you it's within 10 years.
Right.
A humanoid robot priced at around $25,000 to $30,000 US.
Right.
So Tesla is really at the forefront of the development of humanoid robots.
Is that right?
We know that driverless cars are here today, full self-driving. So if you've got a Tesla, you can implement that. Obviously, you have to be behind the wheel at the moment, but that's progressing.
I've got a Honda CRV.
Yeah, well, you might get a Tesla, but the Tesla, essentially, it starts becoming an income-generating tool for you, maybe another asset in your diversified portfolio, because the Tesla drops you off to the more offices, and then it goes about continuing to make journeys like an Uber whilst you're at the office. And then when you're ready to finish up for the day, it'll come back, pick you up, drop you home, and then maybe it keeps on making journeys throughout the night as well. So this is the world that Musk envisages.
Yeah.
Humanoid robots. He views a Tesla car as a robot, essentially. And then, of course, you've had the recent listing of SpaceX, which a lot of people get caught up in the narrative around Musk and going to Mars, etc. But they have a monopoly on launch, for example, in terms of launching satellites into space. They're talking about building data centers in space, but also they could totally disintermediate the telecommunications industry.
So what's that telephone?
Starlink?
Starlink,
yes, correct. Yeah, so I've been pretty frustrated with my NBN in metropolitan Sydney. I was pretty close to getting Starlink, but people rave about Starlink in terms of particularly being more rural and having mobile internet connection, or even having Starlink on planes, for example, or Starlink in your car. With the development of these tools that AI is producing, you're going to need faster and faster connectivity, which is where SpaceX and Starlink could potentially play a role.
Well, I go to Indonesia once or twice, well, maybe 3 times every year, in remote places, and they've got Starlink.
Yep.
And I may as well be in the office.
Correct. Yes, exactly. Which is again, productivity enhancing tool. So really, AI could help to assist the global economy out of the large levels of debt that we have, both in the public and private sectors, and household sectors. Essentially, what we've seen is that governments find it very difficult to restrain spending because it impacts on economic growth, which causes unemployment to rise, which means that I'm less likely to vote for you as a government at the next election.
Yeah.
But if productivity is improving, essentially we can generate higher levels of growth and reduce debt loads in that way. So I believe that, and when I talk to the team at Hyperion, who are at the forefront of allocating to some of these companies, so they have 80% exposure to AI, for example, in their portfolio, I believe that the productivity boom we'll see from AI implementation will rival that of the internet.
So you said that the top 10%, top 10 stocks represent 50% of the Australian market.
Correct, yeah.
And the US, I guess, basically looking at the S&P 500.
Around 30%, top 10 stocks.
Yep. And how much does the tech stocks actually represent in that as a percentage in the S&P 500?
Tech as a whole?
Yeah.
It's around 45%.
45%?
Yeah.
And what's it in for Australia? How much tech we?
Tech, our tech sector is very narrow. It's quite small. I'd have to dig out
1 or 2%?
It'd be, less than 5%.
Yeah, less than 5.
Yeah.
Did you say 45?
Correct, yeah.
Right.
Yeah, as a whole.
As a whole.
For the market, yeah.
So out of the, let's just say it's 50%. So half of the S&P 500's in tech.
And the great thing is it blends really nicely with Aussie equities, right?
Right, okay.
So when you're building portfolios for different outcomes that could occur, you don't want all your eggs in one basket, that old saying. So essentially it blends very nicely with the Australian market, particularly as in terms of Australia, what we do exceptionally well and what we're world class at is resources and basic materials.
Uh-huh.
And so in blending your Australian and your global exposure, you get a really nicely diversified portfolio there for when markets are inevitably swinging between fear and greed or value and growth.
Are we looking at a tech bubble? Are we looking at a bubble here, or what are we looking at?
I mean, that's a lot of clients ask me this question, but essentially there's a 98% correlation between earnings, so the profits of companies, and their price performance as a share, and over the long run. In the short run, as the market oscillates between fear and greed, it means prices can move well above valuations and well below valuations. But the run-up that we've seen in equity prices, and the US and Australian markets are trading at all-time highs, entirely reflects the growth in earnings for the underlying companies. So It's not a bubble.
It's not a bubble.
Whereas in the tech wreck, what you saw were prices were moving higher, but earnings were going nowhere.
Gotcha.
But we're talking about the most profitable companies in the world, and they're still trading on relatively cheap valuation multiples because earnings growth has been so strong.
Okay. So we've spoken about the share market. Let's talk about the bond market.
Yeah.
Where's that going?
I mean, the big concerns in the bond market are at the moment around debt sustainability, so the ability of governments to continue to service their debt obligations, inflation, and higher interest rates. And so all of these impacts are resulting in yields generally moving up across the yield curve. The positive news is that the yield curve isn't flashing any warning signs around recession. Yield curves are still upward sloping, but there's a lot of volatility, particularly when you consider interest rate risk in bond portfolios. If interest rates rise by 1% and your interest rate risk measured in duration is 7 years, then you will lose 7% in capital value. Mm-hmm. So what I've spoken to a lot of clients about today is you want interest rate risk in your portfolio and high quality interest rate risk in your portfolio if you expect there will be a recession or deflation or an unemployment rate labour market shock. Now that's a relatively low probability, but not many people had on their bingo cards the GFC or COVID or invasion of Ukraine or what we've seen in the Middle East. But these are the types of assets that typically perform the best in an economic growth slowdown environment. My view is...
Anthony, I'm seeing clients basically sort of like saying, I've just been made redundant, and these clients are in their 60s, they're not going back to work. This is it. And there's a lot of people being made redundant.
Yes, yeah. I'm not surprised, particularly given the rise of AI as well. So it will be messy in terms of the path of individuals. There will be roles and there will be professions and there will be industries that are disrupted by AI.
Right.
But there will be roles and there will be careers and there are industries and businesses that are created because of AI.
Let me ask you about those.
I mean, as
for
humans,
our kids, I
guess.
guess.
Yeah, exactly. I mean, it's very difficult. So I actually did a careers night to a group of Year 11 students at a high school a couple of days ago, and they were asking, is it still worthwhile to go to university and study?
Yeah.
And what makes it difficult is no one has a crystal ball and no one has the answers. But what you can be confident in saying is that right throughout the last 100 years of human history, we've had fantastic technological advancement, whether it's been the internet or whether it's been the car, whether it's been telephone, whether it's been electricity, whether it's been computers, whether it's been smartphones, etc. And we used to have pools of typists, but we don't anymore. We used to have horse and cart, buggy drivers, but we don't anymore. And so having flexible labour markets, you do see that labour will go to where it can generate an income, and eventually people will begin to retrain. But the roles look will look very different. And so it's important that as we implement AI in businesses, that there's still a human in the loop.
Right.
And what we're actually seeing is that hiring is increasing. So yes, all these software engineers, I mean, AI can code far better than humans can today and more efficiently.
Yeah.
But guess what? Every business needs an AI expert. And who's probably going to be the best? Well, maybe one of these software coders that has been laid off by a tech firm like Block, for example, or WiseTech.
Or a young person straight out of university.
Correct.
I mean,
exactly.
aren't
They're,
they in the
they're
forefront?
going to, they're at the forefront, and they will be the ones that lead the charge. And if you can be the expert in AI within your business, I think you're in a pretty safe seat.
So, yeah, I mean, it's amazing that you've got specific AI people in this business. That's the first I've heard.
Yeah, correct. And yeah, so on the fixed income side, my view is just blending those long duration interest rate risk assets with floating rate note exposure. So these are instruments and securities typically issued by banks and financial services firms that pay you a yield, also described as a spread over and above cash rates.
Are we going to see the Australian 10-year bond creep up any higher than what it is? About 5% at the present stage, isn't it?
I mean, we're very correlated with what the US is doing.
Right.
And overnight, the US authorities actually intervened at the long end of the yield curve. So much will depend upon the path of inflation from here. The bond market is saying inflation is a problem and that we haven't stamped it out.
What can we do? I mean, I've got my view. I mean, they certainly need to sort of like do something about all these government departments that they're actually opening up, and and you know, the NDIS, which is basically something that has to be done.
Typically what you see is that fiscal spending will act in a counter-cyclical fashion. So when economic growth is robust, then governments pull back on spending. But when economic growth falls, governments increase spending, particularly on transfer payments like social welfare payments, unemployment benefits, etc. Whereas what you've seen since COVID is that spending has just been on the gas. And so a 28% contribution to GDP, fiscal spending and government spending has been the strongest it's been since World War II. And as you say, we've seen the private sector shedding labour, but the public sector has been hoovering up labour.
But that can't be a good thing, can it?
Well, what it does is it crowds out the private sector, and it also results in lower productivity. Yeah. So, I mean, I was in Adelaide a couple of weeks ago with a colleague, and we were driving to, I was presenting at a conference, and we saw a cement truck backing out of a lane onto a road. So you had the guy driving the cement truck, then you had a person on either side of the cement truck that was stopping. There was no pedestrians, but was stopping in case a pedestrian wanted to walk in front of the cement truck. Then there was two people on the street as well stopping traffic, and then one person behind the cement truck. Yeah. So essentially what you've got there is 6 people to reverse a cement truck out of a lane, right? Yeah. And they're all getting paid whatever the sort of standard wage is, whereas arguably what you should have is maybe 1, 2. I mean, I'm not an OH&S expert, but it seems like it's a bit of overkill to reverse a truck out. Arguably, those 3 people could be doing something else that's productive.
Well, I drove from Broadbeach down to Burleigh, and I saw there was 15 people working on the railway, the tram. 14 of those was leaning on the shovel, and it had one guy doing work.
Yeah, and I mean, so what it does is if you want to renovate your house, or, you know, it crowds out the ability of you to attract a skilled tradesperson because they're either working on infrastructure projects for the government, state or federal, or they're working in the mines. And so that's what pushes prices up across the board. So it makes the RBA's job harder to get inflation back under control when government spending is strong.
So should we be investing in bonds?
My view is yes, you want bonds within your portfolio. Of course you do, for diversification benefits. Of course you want that. And the level of bonds that you have in your portfolios typically reflects your risk tolerance and also your time horizon. So if you are sort of coming into retirement, you don't want 100% of your portfolio in equities, because maybe equities are volatile. Typically the volatility is around 16%. Can you live with another GFC event when equity prices halve? And you might not have the time for equity markets to recover back to their prior levels. And so, yes, you want fixed income because typically if equity markets are falling, then fixed income is doing well. But you have to be deliberate in that fixed income exposure. And today, having a balance between floating rate note exposure and fixed income bond duration exposure is really a great way to invest and smooth the journey in terms of your return profile going forward.
Fantastic.
I should have mentioned private credit as well. Metrics is another place that investors can allocate to generate higher levels of income that will compensate them for rising costs of living as well.
Yeah, well, that's done very well, hasn't it?
Yeah, it has done well.
About 8%?
Yeah, the Aussie banks have sort of retreated and private credit stepped into the sector to facilitate credit growth. And we have an economy, as I said, that I expect will avoid recession, that will continue to grow. House prices are coming off, yes, but I'm not expecting a big bear market in housing prices. And our population, we're simply not building enough homes to house the level of population growth that we're experiencing.
Well, what can we do about that?
Well, we have to build more.
Yeah.
And the market will find a clearing level. But essentially, when it comes to metrics, they have a focus on companies that have at least $750 million in revenue per annum.
Right.
And they're often in bank syndicates with the banks. So they're typically
lower than that, they don't lend.
No, so you're talking about very well-established property developers in the real estate space. And of course, they make other types of diversified loans to Australian businesses. Woolworths is another case in point, for example.
You just got my train of thought. It's amazing talking to you. Now, one of the things that I don't actually understand is when you look at the Japanese stock market, it's gone up 60, 70% this year. What's happening there?
So there's a new government in place, a new prime minister that has very much a activist agenda in terms of boosting economic growth. So for the first time, we're seeing the Bank of Japan raising interest rates. We're also seeing significant corporate governance reforms. So making, typically what you see in Japan is they're very risk averse, and in many instances, companies have cash on their balance sheet that is actually higher than the valuation of the company in itself.
Right, okay.
And so what we're seeing is that a lot of international investors, because of some of the reforms that are going on around corporate governance and reforms on companies that are listed on the topics on the Japanese stock exchange, international investors are identifying the opportunity in Japan and allocating appropriately. So, for example, I read recently anecdotes of a company that very well established but continues to use fax machines within their business. And so, it's a quick win to get them to try and stop using fax machines. But unfortunately, all their clients use fax machines as well. So, implementing and being activist in that way can help to facilitate better shareholder outcomes as well. So, with Japan,
that's amazing. You're talking about. We all see Japan as like the forefront of robotics, yes. and they're still using
these legacy businesses.
Yeah.
That one case in point is a Japanese toilet manufacturer, Toto.
Right.
So they build the whiz bang toilets, that do flashing lights and shoot water, all that sort of stuff. But they're an AI company now, an AI beneficiary, because they're world leaders in the production of porcelain and ceramics, and that's a requirement for this data center build out that we're seeing. So their revenues from this line of business inflected higher. The stock's up over 100% in the course of a couple of months.
So finally, let's just talk about data centers.
Yep.
And the future of, I guess, basically where that's heading with respect to energy in Australia.
Yeah.
Where are we heading there?
You want exposure to what is called the hyperscalers.
Yeah.
So the companies that are building the data centers.
Who are they?
Amazon is one.
Yeah.
Alphabet or Google is
Google,
another.
Yeah.
Meta, Facebook is
Yeah.
one. Microsoft is another. So they're some of the more high-profile ones. We also have similar companies in Australia, for example, that are building out data centers. But essentially what a data center is, it's like a Bunnings shed filled with high-end computer chips, producing computer power and producing higher compute power. So essentially, in building the data centers, these hyperscalers are now the toll road operators for AI. So when you use ChatGPT or Claude, essentially they're renting the compute power from the data center providers. And when you put in a query into Claude, like how do I make chicken parmigiana, that consumes, not that I've asked that, that consumes a certain amount of tokens. And Claude, Anthropic, OpenAI, ChatGPT, they buy those tokens from the hyperscalers. Now, as compute power is coming on, the cost of producing a token is rapidly falling, but the price the hyperscalers are charging the large language models is inflecting higher. And so their earnings, their free cash flow should begin to explode higher in coming years as well. And what I see is a lot of skepticism around the AI data center build out, but we're talking about the most profitable companies in existence with the best management teams, the best resources that are at the forefront of the technology. And Mark Zuckerberg, the CEO of Facebook, Meta, has articulated it as we're in a prisoner's dilemma. Either we're investing in this space or we have the risk of being totally disrupted by these tools.
How about the quantum computing?
Yeah,
where are we going there?
Similar path of development. As this compute power comes online and as the chips become more powerful and more efficient, what you're likely to see is further advances in that sort of field of development as well in quantum computing. So inevitably, when you're looking at investing in risk assets like equities, you want to balance that to some extent with defensive assets like public and private credit. But essentially, it is a volatile journey. Volatility is the price you pay for the higher returns, for taking higher risks. But over the long run, what you see is that equity markets generally move up and to the right. And the reason for that is economies are continually expanding in nominal terms, and earnings growth is growing in nominal terms as well. And inevitably, tomorrow is always better than today, whether I'm talking about standards of living or whether I'm talking about improving health outcomes, whether I'm talking about wealth, whether I'm talking about educational standards, whether I'm talking about technologies. And so what you find is
you'd hope so anyway, wouldn't you? I mean,
well, it always is. You know, if you're looking back...
It still hasn't played out like that for the average Australian.
Yeah, but if you compare the average Australian's standard of living today compared to their grandparents... and if you sort of if you parachuted back in time and said the average house is going to have 2 cars and each kid will have a bedroom each, and a number of houses, I don't know, 1 in 10 or 1 in 20 will have a backyard pool. Your grandparents and great grandparents will say, "That's unbelievable," right? And so this is what I'm talking about. And so essentially, you are basically investing in these assets because they have the ability to grow earnings. And if you invested the day before the GFC, day before Black Monday, day before COVID, what you found is that 5 years later, the market has been higher than those levels before those big market crashes. So I worked in bond markets for 17 years and I was an economist for 5 of them. And so it was always about sort of thinking about what could go wrong. But what you have on your side, firstly, is diversification and also taking a long run approach in a world that is increasingly short-term focused in its nature and where the traditional news media is increasingly appealing to our negativity bias because of the rise of social media. So they have to attract our eyeballs in order to sell advertising, which is their business model.
Yeah. So I guess basically we've covered many, many things today. And how about we sort of like just end up with a bit of a summary of what you suggest for a balanced investor, typical type of balanced investor, mum and dad investor, where should they be putting their money at the present stage?
I mean, you're the advisor, but definitely my first point of call would be to work with a financial advisor that can appropriately determine what's best for their risk tolerance, but also their goals going forward. Yeah. Depending upon their risk tolerance, I would say generally from a broad sense, overweight global equities for growth. Yep. Use Australia for your income, particularly given we are Australian investors. So we have our assets and our liabilities
like a metrics,
Aussie dollars, like a metrics, for example. Or we have another manager called Coolabah in the fixed income space.
That's Chris Joyce.
Chris Joy, yep. So he's a well-known columnist and political and economic commentator, but he's also the CIO and founder of one of Australia's, I think it is actually Australia's largest fixed income domestically.
Coolabah, is it?
Coolabah Capital
There
Investments,
you go.
yes.
Yeah.
And so, again, investing is really not that hard. We can get caught up in the day-to-day noise, but if you were to ask me where markets are in 3 to 6 months, that's often more difficult to assess than where the markets will be in 3 to 6 years.
Uh-huh.
And so with that in mind, building a well-diversified portfolio, thinking of the long run, having multiple exposures in the portfolio that do well at different times, so that's not entirely correlated and moving as one, is really the best approach to take for the current market environment.
So what you're saying is that you can sort of like give up a little bit of a performance for diversification, which actually reduces the risk.
Correct. And that's a function of we're no longer in a world of zero interest rates. You know, the cash rate here in Australia is 4.35%. And so expected returns are based off that risk-free rate. It's a lot more difficult to generate a 10% return from a diversified portfolio when interest rates are 0.5% than where it's 4.35%. So you don't need to reach and you don't need to take extra risk in order to generate those outcomes that clients are looking for, whatever that might be.
Well, that's a fantastic conversation. I really appreciate your time, Anthony. And we'll do this next year. What do you reckon?
My pleasure. Would love to.
Cheers.
Thank you.
Good on you.
No worries.